depreciating rupee and appreciating bond yields. The rupee has been depreciated by 14% after demonetization of 2016 to 2021, while currency in circulation has increased by 15% of GDP in the same period. Here, depreciated rupee has remained at rupees 75.5 in the hour against the per dollar or against per dollar. In the midst of rising crude oil prices, rising edible oil prices, rising global commodity prices, rising energy costs, rising logistic costs, and other factors. So, bond yield has been forced to appreciate, and bond has appreciated while or on and above 6.35% against the benchmark of government's 10-year government securities. This is the situation where crude oil price has increased by $90 per barrel. All these things have pushed or pressed pressure on the import bill to increase, and out of it, on the one hand, current account surplus has increased, while on the other hand, cost of production has increased by raising physical deficit and government borrowings. So rupee has become weaker and outflow of foreign capital has also become clear. So, or in the midst of this, here the cutoff rate for V3R auction has increased or touched the highest level of 3.99%, while the stock markets have touched a new peak. This is the situation. Here, in the midst of depreciated rupee, rising currency in circulation, the bond yields have appreciated, and it is going to appreciate in future on and above to 6.50% in this physical, by the end of this physical. This is the situation. Here, in the midst of these, the depreciated rupee, appreciated bond yields, a stronger US dollar, foreign capital outflow, and rising fiscal deficit, rising government borrowings. These are forcing to disrupt economic growth in future, and also puts pressure on currency market and financial sector, where all these will be disturbed and will be disrupted by these factors, these rising factors. So, bond market is worried over elevated supply in the midst of demand crunch, lower level of private final investment expenditure, and lower level of private final consumption expenditure along with investment expenditure. Here, in Indian context, bond yield and economic growth has a positive relationship. But RBI is trying to lower bond yield in the midst of appreciating bond yields. But it will be difficult for RBI to lower bond yields in the midst of rising costs, rising other factors, which are forcing to appreciate bond yields, which has increased by 6.35%, which are going to increase by 6.50% in future by the end of this fiscal year. So RBI is in a stressful situation to lower bond yield. RBI thinks to lower bond yield to make it an anchor for other interest rate for providing cheaper capital for investment for economic growth. But the situation is forcing to appreciate bond yields in the midst of depreciating rupee. So depreciating rupee and appreciating bond yields are a real problem before the RBI, and it will be difficult for RBI to maintain a balance between depreciating rupee and appreciated bond yields with the rising currency in circulation, rising government expenditure, rising government borrowings, rising physical deficit, rising current account deficit. These are the problems. In the midst of these problems, RBI thinks to make lower bond yield. It is only imagination, which will not be effective in the midst of appreciating bond yields, because these factors, these expanding factors, these stressful factors which are forcing to appreciate bond yields is difficult to control by RBI, because all fiscal policy makers as well as monetary policy makers have plowed this type of situation in Indian economy before the pandemic, and after the pandemic situation has become aggravated. This is the situation. So it will be difficult for RBI to lower bond yields to provide cheaper capital for economic growth. Thanks a lot. Thanks to my viewers.